Hey, Zoom crew, can you hear me? It looks like I have one participant on the Zoom call. Datley, chime in or hit the comments. Let me know you can hear me. Looks like I got good audio on my end.
Yeah, I can hear you.
I saw you come off audio there, mute, but I didn't get anything on my end. Okay, there I got let's see, I got the chat. It says I can hear you. Great, that's all I needed. Okay, we're ready to rock and roll then. Welcome. Happy Labor Day. It's been 3 weeks, so I'm hopeful that everybody had a chance to familiarize themselves with our Canvas side, our My Business Course side. Mess around with the YouTube side a little bit last week's lecture. I guess a little bit module 2 was a recorded lecture that I posted to YouTube. So let's start the class with general housekeeping questions somewhere. How's everybody doing? Really? Okay. Well, I got one question about companies list. I think I had to be able to include an announcement, so I suspect everybody got that. And I went out to our Canvas site this afternoon to look at our company selection forum, and it looks like most of you have been able to navigate out here and select the company. I just wanted to take a quick look at it because I don't want any repeats, and I didn't see any this afternoon when I looked. Facebook, P&G, IBM, Walmart, Caterpillar. So there's another P&G, but can somebody speak to that? Austin looked like somebody claimed P&G first and you switched to Facebook. Where's Austin? So you got Facebook then? Okay, I think somebody beat you to P&G. Well, I don't know how these are posted. Is it bottom up first or top down first? Top down first. Okay, so you got P&G then. Okay, so Saren, you have P&G too. All right. So I need a volunteer to switch. Let's look here. Hover over the time. Okay, August 21st at 6:16. Let's see what we got down here. Oh, yikes. Beat you by a minute. Ouch. So pick another one. You don't need to redo your proxy or anything if you've already submitted that, but you will need to familiarize yourself with the proxy of the new company. You just don't need to do the assignment again. Okay, P&G, Amazon, J&J, McDonald's, Cincinnati Financial Corp, 3M, Lowe's, S&P, Realty Inc. Where's Joe? Okay, Realty Inc. I'm assuming is a REIT. Sometimes their financials can get a little wonky. So sooner rather than later, take a look. And if you see anything about the real estate investment trust financials that are not going to just, if they got anything weird going on, you might think about switching. Walgreens, AbbVie, Colgate Palmolive, Sherwin-Williams, T. Rowe, West Pharmaceuticals, A.O. Smith, ADP, Dover, Cintas, Medtronics, McCormick, Genuine Parts, Exxon, Target, Chevron, Aflac, Apple, Emerson Ecolab, and Ben Franklin Resources. Okay, I think we're good. So throughout the semester, I'm going to ask you to take a deeper dive into those companies, and I hope to be able to cherry pick one here and another there to pull out their financials in real time and take workshops and things together. a particular need and advance the class, reach out to me, say like, I have $500 equity. It's like, hey, Vern, I can't figure out what Walgreens return on equity is, or return on invested capital, and maybe we can do a little. Deeper dive right there in fun, but everybody kind of benefits when we're working. Now, I'm gonna try to point out what is expected of you all as the portfolio analysts and looking at these companies. As we go through the material. So tonight, you should be preparing yourself to analyze Walgreens or McDonald's or Franklin Co's return on equity. And I'm gonna point out how I want you to look at it. There's certain calculations that the authors give us. It's not these stuff. Once we recognize the components, which I think all of you will recognize the components because you've all had accounting, right? Remember my disclaimer on this class, if it's been a few years since you had accounting, consider getting yourself some help or a little tutoring or refresher course. Notwithstanding, I expect most of these terms to be familiar, plug and play, we get return on equity, and then we'll take a couple variants of that. What you want to do is understand what the return on equity for your company is and how your company got there. That number should tell a story. In and of itself, it tells you how profitable a company is. But I'm going to ask for each of you to look at that number through a historical lens. So I want to see you create a graph that charts the return on equity over time. We'll look at one tonight. And then that graph in turn tells a story. And you'll see the return on equity bounce around from year to year to year. And in each of those years, you're looking at supply chain issues or pricing power or one of the other competitive dynamics that we have touched on in module 1. They all have forces that play in determining how profitable a company is every year. Look at a graph. I want you all to know that story and then to be able to communicate that story back to me in the research report at the end of the semester. So a historical analysis of return on equity with particular commentary on any big variable. If you have a particular outlier here, something's going on there, find out what. And this is not hard because the management team tells you what's going on every quarter. They host an earnings call for Wall Street analysts. And I hereby identify you as Wall Street analysts. You all now work for me. So if you ever want to get on the phone and call into one of these calls, you just say, you know, I'm such and such, the name of my company is 2F. You can say, I'm with 2F Advisors. Now you're legit. They will pay attention. They will answer your questions. They get paid to answer your questions. My brother-in-law is the chief investor relations person for what we hope to be that they do kidney analysis based on Denver. This is his whole job, taking questions for analysts, just like us. So don't be afraid to pick up the phone and call. No questions. You've heard that before. These investor relations people are generally very, very friendly. They like big questions. They will direct you to the resources that you need to understand their business model. As a matter of fact, they have it all prepackaged for you. We talked about this night one. One of the first things that you want to do when you're trying to get a handle on some of these stories is go to the investor relations website because they have it all packaged in glossy PowerPoints, and it's going to tell you the story that you need to know to try to get up to speed with what can seem like a pretty daunting research file. And then as we move through the stuff here, I'm going to try to highlight the pitfalls associated with just taking the investor relations story and get buying. So it's important as analysts that you always remember anything that comes out of investor relations is the story that they want you to have, which I think I can tell that story night one. Whenever I start looking at one of these companies, I'll read the 10K from back to front to get all the good stuff and fine print back. That's the kind of stuff that investor relations is never going to be. So, okay, that's my big preamble. Tonight we're talking about return on equity, and that's module 3. Okay. Very high level, when we talk about return on equity. I already gave away what the definition was, but I want to have a conversation about what that is and why it's important to us. First off, who are we? I set the tone class for who we all are. In this class, we're all equity analysts, right? Okay. Why is return on equity important to an equity analyst? We're thinking about buying a share of this company. So, you need to bring me in, okay? Hey, Andrew, see, this is how I pick on me. Okay, Andrew, and who are you doing research on this semester? Cincinnati Financial. Okay, great company. I happen to own a little bit of Cincinnati Financial, so I'll look forward to that. So Cincinnati Financial, their return on equity, Cincinnati Financial, it's an insurance, property casualty, life, benefit insurance. Why is return on equity important to an investor in Cincinnati Financial? My investment was there we go. It wasn't a trick question. We all want to know how much money we're making. Return on equity tells us how much money we're making. If we finance this business out of our own pocket, we take, I don't know, we're dealing with big numbers here, so call it $100 million to launch Cincinnati Financial, or maybe it's $1 billion to launch one of these larger cap companies. We get a loan from the bank. Now we have $1 billion to $2 billion in capital that we go out and buy desks and chairs and buildings and hire sales forces and research and development departments, and our balance sheet reflects $100 million in equity. That's how much money we put up. That's the book value of the equity. So fast forward a year, we're going to take a look at how much money we made. Where do we find that? We find that on the income statement. So the income statement's in the numerator, and the denominator is how much money we contributed to the company, and that tells us what our return on equity is. Okay, what do we compare that to? If you're the investor, now you own this business, and for the sake of argument, let's say our return on equity in year one was 10%. So what do you compare that? Alternative investment. So everything else in the world that you could have spent your money is the comparison. So 10%, like that, like 10%. Get a couple of heads nodding. It's 5% better than your short-term treasury rate. Last year, the year-to-date, the market's up about 10. So if you're making 10 on your money, that's not too bad. You're up to a good start. So return on equity, very simple formula. We have net income in the numerator, average stockholders' equity in the denominator. The authors of our text are very technical. The denominator of this equation comes from the balance sheet. The balance sheet is posted over a period of time. So we have beginning equity on January 1st. We have ending equity on January 31st. And we're going to divide net income, which is accrued over a 12-month period, into the average of those two numbers. I say they're technically accurate, but they're 100% accurate. I just make note of it because most of the time in practice, I just see analysts take the end of period equity number. It's a shortcut. I like to say in the field of finance, we're not trying to get this right in second decimal point. If we get it directionally correct, meaning up or down, like that's what we're after, right? We want to know if the stock is going to go up or down, and know if the stock is going to go up or down. You got to know how much it's worth. Well, knowing how much it's worth is a directional game. And almost everything we do in this class is an estimate. And we estimate to the best of our abilities based on the GAAP financials that the accounting department gives. This is not an accounting class. This is a finance class, whereby we use a lot of the accounting data, and it's crucial that we understand how that data was gathered into the file so that we can put it to use doing what we want. But there's no rules that govern how we behave. There's no such thing as GAAP for finances.
There's a CFA curriculum, but that's more guidance on how to do a good job of interpreting. So if you're looking at a company like McDonald's, and was about the same company last year as it is this year, and they haven't gone through any big mergers or acquisitions or divestitures, then you'll see a lot of analysts just take end of period stuff over the. Yes.
Isn't it better to take the average numbers and because they don't have a better understanding in that what we want probably right? That doesn't mean it's taking the end ending time.
It is better and it's more technically accurate. I just am telling the story because you see it used differently a lot.
Yeah.
If you're doing your homework or if you're taking the exam, make sure you use average. That's how you'll get the points. If you're out in the real world and looking at balance sheets and they're about the same, you just want to calculate the ROE real quick. You see that done a lot. So if you download a report from Bloomberg or Morningstar or from one of the databases that you can see how that's plugged in the library, you might see some analysts doing it with the shortcut that I didn't describe. Don't be shocked by it. It happens a lot. So I'm just giving you a heads up.
A lot of students have stumbled upon those shortcuts and felt a little bit confused about how that all comes together. So I try to give you a heads up as we go through.
In the proxy statement, you mentioned using cost one. We don't have access to cost one or Bloomberg.
Did we lose Bloomberg too?
Those are great reasons. That's okay, so. Thompson one was a terrific resource. If we had it, I would ask all of you to go out there because they have a great shareholder governance tool. Unfortunately, we don't have it. Or I don't know of any other place to get it, so it's not free process. Grab the proxy, read the proxy, understand how your management gets paid. That's all you need for that. You'll get the board points. As you read the proxy, I would be very interested in and would love to hear about any conflicts of interest that we might have. So those can be very common and give you some insight into just the caliber of management team that you might be dealing with.
Okay, let's take a look at Boston Scientific. This is the calculation of ROE for Boston Scientific. We have sales, net income, assets, equity, plug all those into the equation that we just saw on the last screen. And you can see here that for Boston Scientific, their ROE is 21.24. Now, the S&P 500 on average yielded 13.5 to 15.6 from 2014 to 2018. So 21.2 looks pretty darn good by comparison. What do we need to be comparing? Related firms. So that's part of the ratio analysis that I'm going to ask you to do, and you can find this in a lot of the databases through the Learning Library. Merchant Financial is the one I recommend you first. They're going to have a peer group analysis. Another great database is the IBES. IBES will give you codes for all of the industries classified by the SEC, and then you can pull averages for all those. Then we can compare Boston Scientific to the other companies in the medical device space, because Boston Scientific makes heart stents. One of their big products is a specially coated heart stent that they have on. The margins are very, very high, and it shows right here in their ROE. If you're an analyst for Boston Scientific, what I would want to know is exactly when does that patent wear off, and what is the likely pricing that they're going to have in the marketplace after that patent wears off. So you're probably going to see an ROE chart that goes 20, 20, 20, 20, 20, 16, 14, 12. Then the question becomes, how quickly can they replenish that pipeline? Do they have another version of that heart stent that is in FDA 2, FDA 3, FDA, is there a stage 4 approval or just 2 and 3? I don't remember. But those are the kinds of questions that you need to be asking when you see those numbers. This last bullet point on this slide, I circled here, Boston Scientific was number 97 on the S&P 500 list. I think this was as of 218. So there were at least 96 companies more profitable than that in that year. Okay, let's break down the return on equity drivers. We're going to go through a little exercise called the DuPont analysis, named for the professor that originally championed this approach, whereby we look at return on equity. So we're going to start with return on equity using the formula that we just laid on the screen there 2 slides ago. Net income divided by average stockholders' equity. We're going to set that equal to net income over average assets times average assets over average stockholders' equity. And you can look at those 2 terms there. In that first term, we had average assets in the denominator, and in that second term, which is financial leverage, we have average assets in the numerator. Algebraically, you probably recall, those 2 things cancel each other out. So that's a numerical proof that we can look at. And now we've disaggregated ROE into ROA, return on assets. So the return to total company, total company assets, all of the tangible and intangible assets that they have to balance sheet. Times or multiplied by financial leverage. So we're going to look at Boston Scientific here, and we're going to see how much of that ROE is top 20% ROE. How much of that is return on assets, and how much of it is due to financial leverage? Essentially, what I want everybody to understand here is that you can increase your ROE, you can increase your return on equity by borrowing from the bank. Also borrow from the bond market. We'll spend a whole chapter on that later in the year. But the more debt you have on your balance sheet, the higher your ROE can go compared to your return on assets. Let's look at ROA first. Boston Scientific again, $1.6 billion in the numerator. That's net income divided by average assets of call it 20 billion. That gives us a return on assets of 8.35%. That compared to ROE of what? 20 something. Why do those 2 things differ?
They have higher contribution, like, they borrow more money.
So the other term in this equation that we're looking at is debt. The only difference in this manual between return on assets and return on equity is going to be that debt component. If there's no debt, if the company hasn't borrowed any money at all, then we would expect return on equity and return on assets to be the same number. This is a big difference. Return on assets of 8%, return on equity of 20%. That means that Boston Scientific has a lot of debt on their books. Now, we did see that return on equity was significantly higher than most of the other companies in the S&P 500. If you look at the return on assets, we see that at 8.35%. Companies in S&P during this time range from 5 to 6. So the company in and of itself was more profitable than your average Standard & Poor's 500 company listed. And then in addition to that, they borrowed money on their balance sheet to that ROE number up to the low 20s. So we're pretty happy as investors in Boston Scientific. What, if anything, what, if any, pink flags does that send up for you as an analyst?
high debt company, and when we have a lot of debt on our balance sheet, what do we need to worry about? Bankruptcy. So later in the semester, when we get to talking about debt, I'm gonna ask you to go to the back of the 10K file and look at a tape. And there's a table associated with, well, every company that we're looking at here, but it's gonna lay out the debt payments and the principal payments that your company has coming due over the next 5 years. So we just talked about one of the reasons for Boston Scientific having such a high ROE is because they are in such a profitable business and hard cents. And if those come off pat before next 5 years or simultaneously when they have one of those large debt payments, that can be problematic. That's another question that you need to be asking yourself as an analyst is, what is this company's plan to pay back its debt? Now, if you're an insurance company like Cincinnati Financial, probably don't have anything like that. You're selling to mostly retail clients. You're a little bit linked to the interest rate, but that rate is not terribly high. Those cash flows are fairly sustainable, fairly predictable, and somewhat recurring. It's probably another good example, a little bit of a recession resistant. So if you have a company that has recurring cash flows, you can take on more debt without exposing yourself to as much risk. Vis-a-vis a company like Boston Scientific that's subject to patent risk, or maybe one of the other companies in here that you're all looking at. I mentioned real estate. Real estate can be very volatile. Anything in the commodities industry can be very volatile. Oil, natural gas, debt on the balance sheet of a company whose natural operations are just inherently more volatile introduces more risk.
Let's look at that financial leverage component. Very simple. We're going to take average total assets divided by average shareholder equity. And our authors refer to this here as FL, or financial leverage. Later in the text, they'll refer to the same variable as FLEV, or financial leverage. So be mindful of that. They made it challenging for us by switching the abbreviation, and I'll try to be mindful of that too as we move forward. So you can see that Boston Scientific's financial leverage is 2.54. Nothing challenging about that. Just throw those numbers into that equation. That compares to S&P 500 of 2.4 to 2.74. So not particularly more leveraged than the rest of the industry at large. So they're more profitable, but they have about the same amount of leverage. So it really was profitability driving the difference between Boston Scientific and the rest of the S&P 500. So this is exactly the analysis that I'm going to ask each of you to go through for your target companies. Let me take a little detour here. We'll slide 13. Okay. On this learning objective, our authors are asking us to compute the same variable for common equity. So if we're looking at common equity and we have preferred equity on our balance sheet, what's preferred equity? Anybody ever owned any preferred equity? That's what it's not like. It's preferred, meaning has special preferences. So it usually trades on the open market, with the New York Stock, with the NASDAQ, and buy preferred equity, just like you can on common equity. So if A.O. Smith has shares outstanding, I think what's A.O. Smith, so you can buy common equity under the ticker AOS. There may be a preferred share outstanding, particularly like AOS.PF. AOS.PF is still equity of the company, but it might have a dividend. So it may pay 6%, 7%, or 8%. And that's all you ever get. The language associated with that preferred investment vehicle is going to be contractual. You find this contractual language in the offering memorandum. And after reading that offering memorandum, you may find out that those dividends are
guaranteed. You may find out that they're cumulative, you may find out that they're participating / preferred. There's a world of features associated with preferred stock that might actually make it a much better opportunity to invest. So if any of you have preferred shares outstanding, find out what the contractual rights are that are associated with that preferred issue. And then as we get close to the end of the semester, I'm gonna ask you, well, would you prefer to be invested in common? Or would you recommend that we actually look at the preferred share? And you find some really interesting ones. Sometimes these little preferred issues trade very illiquidly, like they're hard to buy. That's a really good thing for retail investors because a lot of times it excludes all of the institutional investors. So anytime that happens, you can find share classes that are dramatically undervalued. So when you see illiquid shares, and you see liquid bonds, see liquid anything, you just don't trade very often. That can spell opportunity. It's also spells risk, but take a look. So we treat preferred equity no differently than we do debt. The first thing we want to do is subtract out the preferred dividends from net income. Remember, net income is in the numerator. And then in the denominator, we want to subtract the preferred stock. And what we're left with is return on common equity. Return on common equity is what we're all after in this room because we're approaching this from the standpoint of an equity analyst, and that means common equity analyst. Okay, let's go a little further. We just broke down ROE into ROA and financial leverage. Now let's break down ROA into profit margin and productivity. So what we're looking at here is return on assets equals net income over average assets equals net income over sales, which is a measure of profitability. How much income do we use per dollar worth of sales? Times sales over average total assets, which is a measure of asset turnover. So think about average turnover as how many dollars worth of sales does a dollar's worth of assets drive? Building these companies from the ground up, we got $100 million we got invested in property, plant, and equipment. How many dollars worth of sales do those expenditures account for? Let me break it down just a little bit further because the bottom of this slide has our key questions. As an analyst, what we want to understand is anytime return on assets fluctuates up or down, which one of these two drivers was responsible? Is it higher margins? And if it's higher margins, then we're going to ask another question like, what drove the higher margins? Do we have pricing power? Do we have the price of commodities decrease? Did the price of our inputs decrease? Do we have cheaper transportation? What are the factors that are allowing us to do business more profitably? Or are we becoming more efficient? Increased asset turnover. So the assets that we have are driving more sales, i.e., we're operating our business more efficiently. And there's a whole science behind the operations management that delivers these efficiencies into every business that we're looking at this semester. That ultimately shows up in these numbers here. As we break it down, this is a good table to star. These are the ratios that I want you all to look at. That I want you to have a good grasp on how the trend analysis works. So for your particular company under profitability, I want you to look at gross profit margin. I want you to look at operating expense margin. I want you to look at net profit margin, which is profit margin. Under productivity, I want you to look at accounts receivable turnover, inventory turnover, accounts payable turnover, cash conversion cycle, property, plant, equipment turnover. Every one of these tells a story. Every single one of these measures has a whole staff of internal people working on optimizing those numbers. Because remember, when you're looking at something like Apple, this is $1 trillion. Even the smallest of efficiencies manifest in tens of millions of dollars worth of savings. So there's staffs and staffs of financial analysts working on each one of these. So take these ratios. Put them into a spreadsheet. You don't have to calculate anything, again, just go to the Merchant One database, it's linked out there in the resource video that I have on our YouTube site, it'll teach you how to navigate there, if you've never been out there before. It's gonna pull up a screen full of numbers, and you hit the download button, and it imports all into a spreadsheet, you're just gonna have it. Look at it across time, so that you know how these variables fluctuate. Do some digging so that you understand the story about what the drivers are. And then look at those same numbers relative to the period. And understand why your company is more profitable or less profitable than your peer group. Understand why your company is more efficient or less efficient than its peer group. And start asking questions. Why? What's driving?
Do I need to call the investor relations department and have a little conversation?
Here's some great questions. When you start digging into gross profit margins, if you see fluctuation in the gross profit number, well, these indented bullet points here are all potential reasons for that. So competitive intensity has increased. Product line has lost appeal. If you're a retail company, you're always at risk of last season's stock. And you have a lot of obsolescence risk, they call it. Product costs have increased, product mix has changed. Somebody who's doing it in Procter and Gamble later in the semester. We will look at a breakdown of Procter and Gamble's margin by business line. I think they must have 50 brands inside their stable of brands. So if their product mix changes significantly, that can be a driver for bottom line profit. Volume with decline, so on and so forth.
All of those are pretty understandable.
Here's a good representation of what I'm looking for as you all do your trend analysis. This is the chart that shows the operating expense margin. So we're looking at basically operating margin of 19% in 2019. 2000 to 17% in 2018. That's for the S&P 500 as a whole. So the operating expense margin was declining over that time. This measures general operating costs for each sales dollar. So the inverse of this is bottom line profitability or bottom line operating profit. See, this is an expense, so expenses are going down. When expenses are going down, profits are going up. So think back, and it's a little bit out of date, but I don't know, the authors are probably due for another version of the book, I would think. I suspect they want to get paid again. Every time they launch a new version, they charge you all $300 to go out and buy it. So does anybody recall what was going on between probably 2012 and 2018 that would have caused expenses to decline and profits to go up? Yeah, that's the biggest driver. The Federal Reserve took the interest rates down from 5% all the way down. Well, they went to 0. So when interest rates go to 0, interest expense declines significantly. And when interest expense declines significantly, you have profits to go. The reverse of that is happening now. So we'll see how that all plays out. But that's been every conference call in my world now for going on the last 6 quarters. What's going to happen to inflation? How's the Federal Reserve going to manage its way out of this particular scenario? If anybody have any thoughts on that, bring them my way. I need to pass them along to my clients, please. If I think about it, I'll bring some really interesting data on that. We are now at debt to GDP of 118%, depending on any, but it's high as it's ever been. And we, a few of our trading partners are that high, but it's high. So when the Federal Reserve raises debt, the interest in our debt outstanding goes up. Where does that come from? Back to the bond. Whoever owns the bonds, insurance companies, pension companies, investors, banks, foreign national, sovereign wealth funds. All of these institutions collectively own that $30 trillion worth of debt. But it's bizarre. I'm gonna take you back to your econ class. What are the two primary ways to stimulate the economy? Monetary policy and fiscal policy, thank you. So when your debt gets to be this high, increasing interest rates is supposed to constrict the economy. Increasing interest rates is a restrictive monetary policy. But you have these two huge forces fighting against each other when you have this much debt outstanding, because simultaneously, when you're taking money out of the monetary system, you're putting money back into the economy through the fiscal system, because you just increased rates on $30 trillion worth of outstanding debt. So the Federal Reserve is really hamstrung with regard to the tools that they have to fight this kind of scenario, which is one of the reasons why you haven't seen the economy decline. Every other time in the last 50 years, when you raise rates anywhere close to this high, this fast, it sent the economy into a recession very, very quickly, if not a tailspin or hot pricing. We haven't seen anything. I think it has something to do with how much debt we have outstanding. I wish I was smart enough to know where we go from here. I'm glad that's Jerome Powell's job and not mine, because I cannot tell you. Okay. Let's look at a deeper analysis of productivity. Just looked at profit margin. So margin times asset turnover is a measure of productivity. We can look at productivity in a handful of different ways. We're going to start with these three ratios. The first one is accounts receivable turnover, or how many dollars worth of sales is each dollar's worth of accounts receivable generating. Inventory turnover, or how cost of goods sold is how much we're selling. So you can think of that as a sales figure too. So let's say how much sales is each dollar's worth of inventory, and then the same methodology for accounts payable turnover. Now, if we divide each of those into 365, we can calculate, how many days outstanding of accounts receivable, inventory turnover, and accounts payable turnover. These three ratios come together in a measure that we call cash conversion cycle. So if we add all three of those up, firstly, divide them into 365. Secondly, add them all up, and that tells us what? Anybody want to take a measure? Yeah, it's like a boomerang. We take cash and we deploy it somehow. We want to know how fast we can take that cash, deploy it, buy goods and services, and push it through our factory and pay our workforce and sell it and ship it. And a lot of times those are on sale, those are on accounts receivable, and then 30, 60, 90 days later, we actually collect that cash. That whole cycle is our cash conversion cycle. From the time we deploy cash to the time we collect cash from those customers who might have bought on credit. We want that number to be higher or lower? Lower is better. The longer we have cash outstanding, the lower our return. We want to get that cash back almost immediately, because the sooner we get that cash back, the sooner we can deploy it again. And the faster it comes back around, the more efficient our operations are. Every time it comes back around, we're looking at another margin. Remember, productivity times margin equals return on assets. Just look at that slide a moment ago. So the faster our cash conversion cycle is, the higher our return on assets. So if you're looking at a return on assets ratio, and you're drilling and you're drilling and you're drilling and that ROA number might be driven by productivity. Then you look at the cash conversion cycle, and you may have a little aha moment as you see some of the ways the different industries stack up here. If you're looking at Apple, you're looking at one of the most powerful companies in the world, and that's partially evidenced by their cash conversions. This is unusual. You add those three components together, what you observe is that Apple has a negative cash conversion cycle. So they are quite literally getting the cash back before they ever deploy it. Now, how can that be? Well, you only get that type of bargaining power if you're as big as Apple or Amazon or Walmart. So they make all of their original equipment manufacturers, give them the goods and services, so they have inventory coming in their door. And they tell their, Damn Electronics is one of their memories. They go and they tell Damn give us all the inventory. We're gonna build our iPhones. We're gonna partner with Taiwan Semiconductor and others. Build our iPhones. We're gonna ship our iPhones. We're gonna stock our iPhones in the Apple Store, and we're gonna sell our iPhones to the consumer. After we sell the iPhone, we'll collect the cash, and then we'll pay you. So their suppliers take on all of the credit. Their suppliers take on the risk that's normally embedded in a cash conversion cycle. So Apple gets that cash, collects that cash before they ever pay out any of their suppliers, and you can see that their cash conversion cycle is negative on the account, primarily on kind of that days payable outstanding. But
If you came as unwanted, because they are taking the money from people and then, they want to use them and then we take the money back. Is it similar to that or?
no. Take that concept of unearned revenues and deferred revenues and set it off to the side. We're gonna cover that in another model. That unearned revenue is when you're dealing with the end customer. So as the end customer, you pay me, but I haven't done the work. So insurance is a good thing. You pay me, I've agreed to do something, but I haven't done it yet. So those revenues are unearned. This is different because Apple's dealing with their suppliers of inventory, not the end customer, but their inventory. Okay, and so the concept of earnings requires a company to do something. So if I switch that example a moment here, and now I'm one of the suppliers, well, I send to Apple an accounts payable notice. It's not unearned revenue because I've actually delivered on what I was supposed to do. I've delivered those goods or services. So those monies have been earned. They just have not been collected yet. So later in the semester, we're going to go through something called an accounts receivable analysis, where it becomes your job as the analyst to look at those accounts receivable and come to some determination if your creditors are ever actually going to pay. You may have some deadbeat Norm Cushionberry on the other end of the line, and then it becomes your job to write that guy off because he ain't paying. Here's the time series analysis that we do with every single one of these ratios. I don't know, Merck, in this example, we're looking at Merck, so you can see Merck's cash conversion cycle has fluctuated from 116 to 121 to 119. Looks like, those aren't big fluctuations, nothing stands out there, but, from 18 to 17, it did get a little bit better, and those numbers are big enough to have a small financial impact, so be mindful of that. Our authors ask a good question here as you're looking at some of the variability in these numbers. We have favorable trend from 17 to 18, the cash conversion cycle got shorter by 6 days or whatever that was. Our authors asked the question, well, that trend's favorable. Is it too favorable? was too favorable. And well, at the top of my head. But let's see, our authors say beware of short-term improvements at the expense of longer-term market position and supplier relations. So supplier relations might be a good example. You could decrease your accounts payable days outstanding by switching suppliers. But that's the kind of thing where short-term gain, long-term pain. If you're switching to a less reliable supplier that agreed to more favorable terms, but doesn't have the same historical reputation, credit quality, reliability, so on and so forth. You may have just added risk to your business for short-term boost your earnings. Remember from night one where I was talking about the game you play all semester long to find the penny? Well, that's exactly the type of move that an executive might pull if they needed to find a penny or two of earnings at a particular quarter. And why would you want to sacrifice the long-term health of the company to find an additional penny this quarter or next quarter? Your bonus. Somebody found this in the proxy. That's why we did the proxy analysis first. I heard it over here. Yes, that's why we did the proxy analysis first. I want you to understand what your incentive compensation is linked to. What management teams all have incentive compensation. They're usually linked to earnings per share or something similar. You're close. Close. Getting that incentive comp to fast. That game of finding penny becomes slow. Get you to look at these types of changes in accounting. I gave you to look at these types of changes in estimate through that lens. Train yourself to do that. You'll find some things that just kind of jump out as weird. And then subsequent to that, you'll find some executives ringing the register on huge paydays. And then subsequent to that, you may find yourself an opportunity to ring the register on a huge payday. And send a little bit back my way for as a commission. We'll call it good. Okay. Property, plant, and equipment turnover. This is another measure of efficiency. The calculation is identical to the ones that we just looked at, with the exception of property, plant, and equipment in the denominator. Okay. I want to shift gears a little bit here, and we're going to look at another measure of return on equity. Okay, let's look at return on net operating assets. A little bit of a sophisticated concept, so I want to see if I can phrase the question correctly. We just looked at return on equity. Now we want to look at return on net operating assets. Let's start with the comparison between return on assets and return on operating assets. I'm simplifying it just a little bit further. These terms are interchangeable somewhat. What's the difference between assets and operating assets? Yeah, so again, not a trick question. Operating assets are the ones that are getting us paid based on the normal course of operation. So you all are looking at some very sophisticated companies. It's not uncommon for them at all to have business interests that are not germane to the day-to-day activities of, let's just call it, their underlying core business. Company like Apple, they issued a dividend policy a few years back, but they had accumulated nearly $1 trillion. Several $100 billion. I think it was $300 billion. Just accumulated profits. Absolutely amazing, incredible successful. And the question every analyst wanted to know is, what are you going to do with $300 billion worth of cash? And Apple didn't have a good answer. They finally issued a dividend, and I think they've done some M&A since. But the difference between return on assets, and return on operating assets is just that. We would remove the cash from operating assets. It's a dead asset, it's just sitting there, it's doing nothing. If we want to assess how profitable the underlying business is, then we'll look at operating assets. Why would we want to assess how profitable the underlying business? Anybody ever read Barbarian Flip a Gate? It's kind of the first big, merger arbitrage, type of financial transaction in the late eighties where RJR Nabisco was bought out by. Oh, it's failing me now. It'll come to me. So if we know how profitable the underlying business is, then we may be interested in buying that business in a leveraged buy. So we can pull together and consort of capital and go buy a company like Apple or out there and just, another company with a lot of cash on its books. We can immediately deploy that cash, basically stick it in our pockets. And then the rest of it is the core underlying business that, well, that's what we care about. That's why we want to know how profitable that business is, because that's what we're going to be left. There's another famous example. Ted Turner. I can read this story right here. Ted Turner bought, I think it was 50,000 acres of land in a real estate transaction that was quote unquote that Ted asked him. Because it was just sitting on the balance sheet at a book value of historical cost and it never been marked to market. He realized that it was a non-operating asset, not really reflected in the underlying financials. Went in, bought the company, sold the land, and immediately turned a profit. And it's another one of those famous transactions like RJR. I just butchered it. But the point of this story is that if you can develop a mind for separating operating assets from non-operating assets, then these financial transactions will emerge over time. And a lot of very, very smart people have made very, very successful careers. You'll see what one of these types of. So when we break it down, let's look at the formula here. Return on net operating assets equals NOPAT, net operating profit after tax. That sounds just an awful lot like profit. Net operating profit after tax. The only difference is we're going to strip out any monies that come from non-operating activities. So if we're earning interest on that cash, and then that interest will not be included in this NOPAT number. That's our numerator, and our denominator. We have average net operating assets. So we're subtracting out like the cash we just talked about. This gets a little confusing because it's an art, not a science. What's operating, what's non-operating, what's core, what's non-core? Is the business really using that asset? Is the business really not using that asset? And every single one of the balance sheets that you all are going to be looking at this semester has their own nomenclature. So use this as an example. And from this, try to identify operating and non-operating assets so that you can pull from each of those and make this calculation. Generally speaking, you're going to have some measure of NOPAT on the income statement. The balance sheet's a little tougher. Okay, let's look at NOPAT here. Net operating profit after tax. Everything on this list is normal. Sales, cost of goods sold, the SG&A, selling, general, administrative expense, research and development, impairment, so on and so forth. Everything on that list is normal. When you look at the income statement and you see something that's not normal, not recurring, not germane to the underlying assets of the company, that would be something that you might scratch through or remove from other operating expenses. I mentioned that the income statement is a little bit easier to decipher because generally you'll see operating income on the income statement. And then everything underneath operating income is not operating. And what do you usually find underneath operating income? Most common line item is interest expense. But if you were to distill this whole concept down to most common terms, OPEC generally excludes. A lot of companies will have other stuff in there that they make money from, but the biggest factor is generally interest. Now, let's just take that interest example and drill in a little further. When we look at interest and subtract that out, we also have to recognize that interest is deductible from a tax standpoint. So if we're going to remove the interest, we also want to remove the positive effects that deducting that interest had on profit. So we calculate something called a tax shield. Top line here again. Net operating profit after tax equals net operating profit before tax minus the tax on operating profit. The tax on operating profit here on the second line equals the tax expense. That's easy, we get that directly off the income statement, tax expense, plus the interest tax shield, which is calculated as the pre-tax net non-operating expense, i.e. interest, and maybe some other stuff, times our statutory tax rate. What's our statutory tax rate? 21. Yeah, I think Bob is here cited as 22. So that's a quick way to plug in the figure for that second term, or there's a table in the back of the 10K. I think this is module 10, so we'll get it. I'm going to ask you to do an analysis of the tax situation for each of your times. There's a table in the back of your 10K that details the effective tax rate for your company. So that's actually the number I prefer when you're using or calculating the interest tax shield. I like to see what's actually happening. The statutory tax rate is one thing, but if you're dealing with a multinational conglomerate that does business globally, well, you're gonna have tax rates globally. And I think you should use the tax rate that is actually applied, and you'll get that in the back of the 10K. Okay, I only have 10 minutes left, so I'm moving quickly. I'm not going through these examples because the examples are fairly self-explanatory and are just asking you to plug in the definitions for these numbers into the given equations to get the right answers. And fortunately, that's the same type of questions you're going to see on your homework. So look at the examples from the PowerPoint, look at the examples in the book, look at the guided examples in our My Business Course website. Those will all help you guide yourselves through the homework. I thought this was interesting. We're back to looking at Boston Scientific. We broke down Boston Scientific's ROE, return on equity, at the top of the lecture. It was 20-something percent, 22%. When we look at Boston Scientific return on net operating assets, well, let me say their ROA. When we look at their return on assets, it was 8%. When we look at their return on net operating assets, we get something at 12.37%. So their return on assets was higher than the S&P 500. They were a more profitable company. When we look at return on net operating assets, we see that calculates at 12.3, and they're right in the range of the S&P 500. So they are no longer a more profitable company than the S&P 500 at large, which means that some of their margin is coming from non-operating assets. What are those non-operating assets? They're yielding something. It's causing their profit to be lifted above their S&P 500 peers. That's the type of question that I want to see you all answer in these research reports. Okay, I think that's about everything I wanted to hit tonight. I thought this graphic was pretty interesting. It shows net operating profit margin along the horizontal axis and net operating asset turnover along the vertical axis. And you can see as turnover increases, the profit margin decreases. As profit margin increases, generally turnover gets lower. So you can see like railroads, that's an incredibly capital intensive business. You wouldn't expect railroads to be able to turn over their assets very quickly because they have so many assets. It's hard to generate that many sales. So where you want to be on this chart is towards the upper right, I guess. So you have biotech, semis, application software, communications equipment, household products. Those are some of the industries that I would be most attracted to. And we talked about the concept of a moat last time we got together. A moat is something that gives a company some sustainable, think about a moat around a castle, as something that keeps the guests. And in this analogy, we're talking about that as a company. We're looking for a sustainable competitive advantage. Those are the types of companies that I would say probably have a sustainable competitive advantage. So if you're looking for industries with a moat, that's where I'd look. And then it becomes something of a waiting game from the investor's standpoint, because we want to get those companies at the right price. Okay, last thing I wanted to cover tonight is return on invested capital. That's an interchangeable term. When I was in my undergrad and in my master's degree, even in industry, the most common term was return on invested capital. That was all of the only term I heard executives use, return on invested capital. I want you all to recognize that as the exact same thing as return on net operating assets. So our authors use the term return on net operating assets. That's the same thing as return on investment. In each case, we're looking at only those monies that have been deployed or invested in the core operations of the business. Okay, gang, that's what I wanted to cover tonight. We have 5 minutes, so before I dismiss, hit me now with questions. I like to do my questions group, because my experience taught me good question. So somebody else. How many years do you want to ideally 10. So that sounds like a lot, but again, you should be able to download these directly into an Excel spreadsheet. And if the data is not available, then it doesn't have to be 10. Do 5, do 3, whatever is available. Don't go to any heroic measures. One of the reasons I asked you to pick from the list of companies that I asked you to pick from is because they've all been around for a long time and they should have lots of historical data. Okay, thanks all. Appreciate your time.
Andrew, nice to meet you. Thanks for the card.
Sure.
You know. So that's,
I have Andrew, I have Austin, I have Frank, I have Mark. Yeah, got it.
Got my, stable. Is that okay?
Hey, that'll work.
Oh, I didn't have a picture, I didn't color.
You know, that's your interesting fact right there. Yeah.
So I had a question, I'm doing Franklin Resources Inc. That's my company and
Mutual fund company.
yeah.
Okay,
That's
cool.
I might as well find some more about it. There's 3 people in the company, on board that they're all related to each other.
Thank you.
Thank you. Is that something?
It's family owned business, yeah.
Is it? Okay, so
And
that,
and it has been for a long time.
that's nothing that's gonna like the future, or should it be?
Well, I mean, those are shareholder governance issues. Yeah, yeah, if you buy that stock, you just have to know that if you ever have to vote, you're gonna get outvoted by the interests of the family. The interests of the family are always gonna come before yours. So if this is a benevolent dictatorship, then you're fine. Hershey's another company that functions that way.
So as long as you're not having much say in what goes on.
Yeah, you have to be comfortable.
Okay, that makes sense.
What would be difficult with staying with Realty Income versus going to a different company that wasn't a REIT?
Sometimes they have funky accounting, and I can't give you a great example off the top of my head, but
You
they're more similar to a bank than they are like a traditional manufacturing company.
Okay.
And I'm okay you doing the,
I mean, honestly, even if I have those points, because anything I'd rather learn about the REIT more than another company.
Okay.
So for me, it would work.
all right, I just wanted to kind of give you that heads up in advance, but if you're okay with